What's up, everybody? It's Austin here. I am on a journey to build a $1 million portfolio, and I'm doing it right here publicly on YouTube. Today, we're talking about 3M. This is my portfolio. You can see down here, I've got a position in 3M stock. It is currently an $11,000 position. It's down $761. So we started off with it at about $12,000. In this video, I'm going to talk about 3M. I'm going to talk about the dividend, some of the risks to the dividend, what I think my future returns could be owning the stock. And then at the end of the video, I'll just go a little bit deeper into my portfolio so you can see what I've been doing and how the portfolio has been performing. Little spoiler alert, it hasn't been great, right? But that's how investing goes. So let's look at 3M, right? Here is 3M's chart using fast graphs since 2003. And this isn't a chart like technical analysis. This is actually one of my favorite ways to look at a stock and understand fundamentally what is going on with the stock. So the first thing I like to do with any stock is just see what its performance has been long term, because performance is not an indication of future returns or anything like that. But companies that outperform tend to continue outperforming as long as they don't get to an extreme valuation scenario, right? And if you think about it, it makes sense. If a company is doing well, they're going to get a lead on their competitors. People are going to want to work there. They're going to be able to reach scale and produce things for cheaper. All kinds of different things really start to go well for companies. So I like to see past performance, and I like to see market beating returns over the long term, because if a stock's not going to beat the market, I might as well just own the S&P 500. Well, bad news for 3M. Since 2003, stock's only up 5% per year versus the S&P 500, if you would just own SPY, up 9.48%. So basically almost double the return from the S&P 500 than 3M, right? Now, the thing is that 3M is way down right now. It is at one of its lowest multiples that it's ever traded at. And another spoiler alert, but this is not a fast growing stock. That's one of the reasons I own the stock. It's the primary reason I own the stock. It's paid a dividend for like 65 years straight. B, it's a critical company if you think about the global economy, especially in the United States economy. And then C, there's so many negative things about it right now with all these lawsuits that it's trading at one of its lowest multiples that it's traded at since the great financial crisis, right? And in a market, I think the S&P 500 right now is overvalued. In a market that I think is overvalued, a stock that's trading at a blended PE of 10.5 with the history that 3M has, I like it. But before this downturn here, which the stock since, what's that, June is down 44% since June, right? So if we actually want to look at it, into 2017, right? So this kind of high, which it was only trading at, so it's trading at a PE of 28, which is kind of ridiculous, right? Let's go to something reasonable, and we'll go to April 2019. And if we actually look at that, so let's see, this is with the little drop there. So whatever, that's good enough, right? I bet if we go to this, it's actually performing quite a bit better, and it's not outperforming the S&P 500 since 2003. So from 2003 to 12/31/2019, but its compound growth rate was 8.65% versus the S&P 500 at 9.77. So at least it's a lot closer there, right? So that's where I think the opportunity comes with 3M, and it could certainly be a falling knife, right? And I'm about to get into some stuff about their dividend and some things we need to be concerned with, as well as their last quarterly earnings. But let's start to layer some things on to this graph. And I want to explain what these things mean on this graph, right? This orange line represents a PE ratio of 15. And if you look at the stock, it is only traded below a PE ratio of 15. You can count the amount of times it's traded below a PE of 15 on one hand, right? Really the period of 2008, that's one. Rallied back up. In 2011, that's two. Got back down under a PE of 15. Stayed there for a while. 2020, after COVID, that's three. And, now again, it's on its fourth time trading at under a PE of 15. And the thing I like to look at is when that's happened in the past, what have the returns been like afterwards? And, we won't use the great financial crisis because that's like extreme, right? But if we just go to 2011 when it was trading at a PE of 12, and we bring it back to, again, and I'm trying not to go extreme here because I don't want to plan for extremes, right? A PE of 22, I don't think 3M will, maybe ever trade at a PE of 22 again, right? But from a PE of 12 in September 2011 to a PE of 18, I think it's possible again, for a PE of 18, not likely, but possible. Uh, you get a 97% return from 2011 to 2014 for 25% annualized because you were opportunistic about buying the stock when it got down to a PE of 12, right? And so now we're sitting at a PE of 10 and a half, which is lower than 12. So we don't need it to go up to 18 to get a good return, right? So what this orange line does is we can see in 2025, based on expected earnings of minus 14% in 2023, and then 12% and 8% in 24 and 25. So based on those earnings expectations, that's what these dotted lines represent. In a PE of 15, price earnings multiple of 15, from now until then, it would return 51% for a total annualized return of 16%. I personally think the S&P 500 is overvalued. But in general, the S&P 500 returns about 9 to 10% per year. My forward return expectations for the S&P 500 is lower than that because I think the S&P 500 is overvalued. And so when we compare, a 6-7% annual return, what I think we'll probably get over a number of years from the S&P 500 versus a 16% potential return from 3M on very conservative, a very conservative PE of 15. I like that. I like it a lot. All right. Now let's add dividends in. Let's add the dividend yield in. We're starting to add some things to this graph, right? Now, again, the dividend yield right now is 4.97%. It's actually that's outdated, right? It's actually around 5.8% dividend yield right now. Look at how often in history 3M has had a above 5% dividend yield. Really, I'm not seeing it anywhere ever before, right? Back in 2008, when the price got crushed, the dividend yield got up to 3.48%. You can see down here how that dividend has grown over time, right? And so, again, they've paid a dividend, I think, for 65 years straight. And this is where we can jump into Simply Safe Dividends. This is a dividend tracking tool that I use. I pay for it. I'm a paying member. And this is my 3M position. Again, I showed you my portfolio. I like this tool because it's great for dividend stocks. So again, the dividend yield right now is 5.82%. If we look at the 5-year average, the 5-year average dividend is 3.39%. And again, back to this price to earnings multiple. Price earnings multiple 11.5, 11.9, whatever. The 5-year average is 18. So it's trading below its 5-year average PE. The dividend yield is way higher than normal, which means the stock could be undervalued or it's a falling knife. We'll see. It's trading below the PE ratio of the sector. It's at a 52-week low, essentially. And so there's a lot of things there that could mean a stock is undervalued, right? We'll get into the earnings payout ratio and stuff in just a second. I want to jump back over here to fast graphs just to do another kind of quick comparison. And we talked about the average PE ratio that it's traded at, right? Well, we can add this blue line is now the average PE ratio of 18. So let's say, I think this is unrealistic, but I think between these two things gives us a range of what the price could be, right? Between the PE of 15 and the average PE of 18. So if we go from here, we got it from the PE of 15. That's a 16% annualized return through 2025. Okay, that's kind of like the base case, we'll call it. if it gets back up to its normal, its average PE, which I don't think it will, but it's, things get crazy sometimes. That's an annual return of 26%. Any investor in the world would love a 26% annual return. So that's what I think, that's my personal expectations owning the stock, is that, more so to the PE of 15. And I'm happy with that return, right? Okay. Let's jump back into some of the important things to pay attention to with dividend stocks, and why I think this is in the title of the video, it's my risky dividend stock. This is a risky dividend stock right now. There's a chance that they're going to cut their dividend, and that would be bad. So let's look at this, right? All right, dividend growth. The last year in February of 23, I guess they just raised the dividend, 0.7% raised dividend. The last 5 years, it's gone up by 5% per year on average. In the last 20 years, it's gone up by 8% per year. And you can see what that looks like over time, right? So 2004, we're around $1.60, $1.70. And by now we're up to $6 a share in dividends. That's incredible. That's a 300% growth in dividends over time. That's amazing. 64 years of dividend growth, 64 years of uninterrupted dividends. They pay quarterly. It's got the, again, annual payout of $6. We talked about the timeliness, and then this is what we need to pay attention to. And this is where the yellow or red flags come in, aside from and it's because a lot of this liability stuff that they're being sued for, right? And we'll get into that in just a second. So historically, and this is why I like Simply Safe Dividends. It gives you a dividend rating, right? And we have a borderline safe dividend rating from them. How did they get there? What is that about? It comes down to payout ratios. Earnings payout ratio, they want it to be below 60%. Right now, it's right at that threshold, 59%. And over the next 12 months, it's up to 69%. Why is that the case? Well, it's because there is that drop, and we talked about on that fast graph, there's the expected drop in earnings per share expected over the next 12 months, dropping from $10.01 earnings per share over the last 12 months. If we look forward, expected $8.65 over the next 12 months. Now, where it gets really bad is if they have to lower this number and it's lower than $8.65. Well, how are they going to pay their dividend, right? How are they going to continue to pay their dividend while they're investing for somewhat of growth and doing these different things? Free cash flow payout ratio is also high. Free cash flow per share, you can see it was growing. It was growing. Same thing with earnings per share, flatlined, and now expected to drop back to where it was in 2019, 2020. Free cash flow, same deal. Big drop here in 22, and then over the last 12 months. So earnings per share growth. Now this is taking that and putting it into percentages, right? We're sitting at 6%, 11% growth, 8, 12, 14, minus 15 in 2019, minus 2 in 2020, 16% in 2021, 0% over the last 12 months. And then over the next 12, minus 14% earnings per share growth is what's expected. Sales growth, you can see it's been lumpy as well, minus 3% in 2022, not good. And then shares outstanding, right? So we like to see shares outstanding come down over time. If a management team is good at buying shares at good prices, it means if they see that as a better investment than investing for growth or something, share buybacks can be great for stocks, right? It's not good when they've been buying higher and the stock is now at a 52-week low. Ideally, you would have liked to see them buying now versus back then, but still, since 2013, they had 694 million shares outstanding. Now they have 568. At least they're not getting diluted, right? You're not seeing more shares. More shares are bad for stocks because every share that gets issued, it makes the existing shares worth less. And we talked about it, right? Total sales. So return on equity, how many dollars of profit a company earns for every dollar shareholders have invested in the firm. Warren Buffett tends to favor firms with consistent mid-teens returns, which indicate they could possess an economic moat. So above 10% is what they prefer. And 3M has actually been pretty good in terms of return on equity, and still is pretty strong, 39%. Return on invested capital. Dividends a firm's profits, divides a firm's profits by the money both equity and debt holders have given the company to gauge management's capital allocation skill. An advantage firm typically earns stable and above average returns over time. Above 8% is the preference. They've been well above that. And even though things have gotten worse, they're still at 17%. Okay, operating margin, a measure of profitability that divides operating income, what's left after a company deducts its cost of goods sold and operating expenses, by total sales. Higher, more stable operating margins can be a sign of an advantaged business. Okay, if they're more profitable, that's a good thing, right? Above 12% is a preference. They were up 22 up to 24, has fallen off a little bit to 16%. Free cash flow margin. Okay, I'll probably stop there, right? We'll go with free cash flow and then we'll kind of stop there. Free cash flow is the amount of cash a company generates after paying all of its expenses and investing to maintain and expand its business. Profitability metric divides free cash flow by sales. The best companies generate high and stable margins. They want above 5%, been solidly above that, and now they're at 10%, right? Okay, and then their debt is the net debt to EBITDA below 3 is the preference. They're at 1.55. Net debt to capital below 0.4 is the preference. They're at 0.47, so a little bit high there. And then interest coverage. This is tough, and I said I was going to stop, but this is important to cover. Divides operating income by interest expenses to gauge how easily a firm can meet its interest obligations. If a company has significant debt, interest payments can consume most of its cash flow and potentially pressure the dividend. That's why that's important, right? Above 8 is the preference for most companies. They are still above 8. They're at 12, but you can see how it's been dropping, right? And so there's a lot of things working in the negative direction with 3M that make it dangerous. The other thing I love about Simply Safe Dividends is they publish notes, right? They update you. So they had a safe dividend rating of 75. They downgraded it on February 24th. And here's the headline why. Weaker cash flow projection, ongoing legal pressures cloud dividend outlook. Okay, it was once a steady industrial giant, faces a challenging outlook as souring economic backdrop, tempers earnings expectations, and attempts to maneuver away from PFAS, which is environmental stuff, and then earplug litigation lose momentum. Retailer inventory reductions, soft consumer electronics demand, and a slowing economy led management earlier to introduce 2023 adjusted free cash flow guidance that came in about 25% lower than what analysts expected last fall. 3M's free cash flow projection of approximately $4.5 billion still covers the $3.4 billion annual dividend, does not include legal costs that reached almost $1 billion. So if you look at that, their free cash flow of $4.5 billion barely covers the $3.4 billion annual dividend and then $1 billion last year that they had to pay in legal costs, right? While these costs will eventually fade, they are stretching 3M's forward-looking free cash flow payout to almost 100%. That's what I just talked about. Additional headwinds that could challenge 3M's free cash flow outlook include upcoming separation costs tied to this year's planned healthcare equipment spinoff, looming recession risk, and 3M's intention to exit the PFAS manufacturing business that we estimate has contributed around $100 million a year to free cash flow. Stretched dividend coverage could become more troublesome as it seems increasingly likely the company has to pay sizable earplug and PFAS settlements, which analysts estimate could range from $10 billion to $50 billion. Because these estimates exceed the firm's $3.5 billion cash reserves and annual free cash flow after dividends, 3M would need to finance these potential settlements to some degree by issuing debt. Based on 3M's reduced earnings outlook for 2023, assuming $10 billion of debt is needed to settle litigation claims, we estimate the firm's leverage ratio could spike near 3 times. Even after accounting for a one-time cash dividend 3M expects to receive from its healthcare spinoff. All right, so those are the risks of 3M. We talked about the valuation. We talked about what I'm excited about for the stock. Basically, I think that they'll figure this out. I think that The litigation stuff actually won't end up being as bad as is potentially expected. That could give them a little bit of um, leeway with that dividend and some of those expenses. And again, I think that the stock is actually discounted to where people think the dividend cut is coming, or if it did come, it wouldn't be too damaging. And so I just think the risk reward for me personally, that's why I own the stock, right? And so this is pretty cool. It shows you my shares, $11,693 market value. It's about a 7.8% position in the portfolio. I'm down about 7% on those shares. It gives me a nice $681 in annual income, at least for now, until they cut the dividend. That's 11.5% of my total portfolio income. My yield on cost is 5.43%. I have 113 shares at about $110 per share, right? So down on the position. And then here's a quick look at my portfolio. If you made it this far, it means you probably learned something from the video. You can help more people find it and support the channel by liking the video, subscribing to the channel so you don't miss my next update. And then if you want more of this, I have an email newsletter, an investor newsletter I send out every week, investor.beehive.com. It's down in the description below. Here's a look at the portfolio. You can check it out. I go more in depth on all of this stuff in my email newsletter. So subscribe and check it out. Thanks for coming. Come back for the next one. Have a great week.